Good afternoon, everyone, or good morning, good evening, depends on where you are. Welcome to the Black Swans and Boom Times, a look at construction risk analysis post-COVID in the P3 sector. My name is Rebecca Adair. I'm a Vice President Senior Analyst at Moody's Investor Service. Moody's is very pleased to sponsor today's panel discussion. As you may know, Moody's raise project finance and infrastructure transactions around the globe. And in Canada, we're in all major infrastructure sectors, including P3s in the transportation, social, and energy space. I cover portfolio P3s and project finance names, and I also lead new rating assignments for P3s and other transactions. It's my great pleasure to moderate today's discussion. We'll be focusing on the current state of the P3 and construction industry, and also on look-forward basis. What are the lessons learned? What can we do differently considering some of the challenges we're facing? What are the trends we're seeing? I want to first thank the Canadian Council for Public-Private Partnerships to host this conference. Thank you for all of you to join our discussion, and thank our panelists to volunteer their time. We have three highly respected industry experts on the panel. It's truly an honor to have them with us today. I know a lot of you may know our panel members already, so I'll just provide a brief introduction to them. Their bios are on the C2P3 website for your reference. I'll start with Vickie Turnbull. Vickie is the Managing Director and Co-Head in Infrastructure Finance at RBC Capital Markets. Vickie is a well-recognized industry leader, and she has been involved in over 80 infrastructure transaction bid in the capacity of the lead financial advisor or debt originator. Vickie also plays a very active role in various industry organizations. She almost needs no introduction given her experience in the P3 sector. Raymond Bassett is a Vice President, Chief Underwriting Officer at Travelers Canada. Ray is an industry veteran with more than 35 years experience in the construction and surety industry and has led both the underwriting and claims practice for leading national companies in Canada. Ray is the current chair of the board of the Canadian Construction Association. He's a sought-after speaker in many events. Great to have you here, Ray. Last but not least, Paul Kraus is a business development manager with BARNARD Construction Company. Paul has over 20 years hands-on experience in the industry. He leads P3 bids and has been in the field running some of the company's larger projects. Paul not only has the first-hand experience as a construction contractor, but also we would very much appreciate his perspective from south of the border. Welcome, Vickie, Ray, and Paul. We look forward to a very interesting and informative discussion. Before we kick it off, just a quick note that we encourage you to ask questions throughout our discussion. We'll be gathering the questions. We'll set aside some time at the end to answer your questions. With that, we'll start off with our discussion. I'm sure we'd all agree that we're at a very interesting time in the infrastructure space. We're obviously talking about P3 construction industry in the context of elevated government spending in both Canada and south of the border. At the same time, the industry is still dealing with the aftermath of COVID, with many outstanding supervening event claims, construction delays and cost overruns, supply chain issues, skilled labor shortages, and also rising commodity price, insurance premium, and so on. We've seen some contractors exiting the P3 market, some projects with only one bid, some consortia pulling out right before the bid submission. We thought a good place to get us started is to perhaps get an overview from our panelists. What is the current state of the P3 construction industry? Do construction contractors have the capacity, willingness, and ability to absorb the increase in demand without a large corresponding increase in price and margins? We'll start with Paul and get Ray and Vickie's perspectives as well. Over to you, Paul.
Thank you, Rebecca. I think, it's been, a challenging last couple of years, but, from our perspective, with respect to the P3 delivery model, it looks positive that, we're going to see more of these, the P3 projects come out. With the infrastructure discussions that have been going on, I think history has proven that that's where a lot of the P3s, fall. So, we think, we're expecting or anticipating, more forthcoming, not only in the United States, but also in Canada.
Ray, can we get your view on this as well?
Sure, thanks, Rebecca. And I guess you've invited us to look ahead to the challenges and lessons learned. So just an observation, if you think back even 5 years to the number of projects that are $1 billion or more, the scale has escalated, right? If you just look at the current projects in the market now, there are just so many that are at that size. So what it's meant for contractors, across North America is it's not just the design build portion that's embedded in the P3. It's governing the model that is the additional challenge, and that's where construction companies have invested a great deal of time and energy in developing their people to manage projects, right? But you layer on the governance of this model, and that it gets a little more risky. It's almost a tale of sort of two cities. The vertical side has performed better, I would say, in the P3 space than has the large civil side. And we had done a study, and I shared this with the three of you beforehand. I think the idea was to share it today. So maybe if I could ask the producer to pop up that one-page slide. Travelers did a study of 225 odd heavy civil projects across North America. It's a 17-year thing. The jobs are all over 250 million, average size 800 million. So it's a good sampling across North America. And we're just going to share that one slide if the producers can pull it up. And you'll see that the trend, we're looking for performance by contractors, and we're sort of comparing the margin, the contractor's bid margin on projects of different models, so CM and design build, and the design build in a P3 model, comparing the bid margin to the closing margin. So what happened? Were they able to sustain the margin? Did it increase or did it decrease? And I don't know whether you can see the slide. It's not showing on my screen, but if it's what you would have seen if it's available is you'd see that the bid margin across really all the styles, so these design build to CM to design bid build, even to P3, the margin going in is similar. It's almost identical across the 17 years across those projects. Very little differentiation, but the outcome on the P3 side is to say horrific would be an understatement. Ultimately these margins struggle to get to 1%, if I can sort of put a number on it without getting too granular. So I think, to your question, Rebecca, why are contractors starting to stand back from the P3 model? Why are they challenging the risk transfer? Why are they perhaps not bidding? And you referenced a few recently where projects rather not bid or they've been withdrawn from the market. This kind of the performance or the inability of a contractor to hit these price benchmarks accurately over time. And the why, as we studied it really comes down to fixed price, fixed time at 30% design. There's a lot of other things. But if you had to put it down to one thing, if you're trying to bid something in a P3 structure with a 30% design in the civil space, it's extremely challenging.
Vickie, can you share your view as well from your perspective?
Sure. And look, the standpoint that I look at things is from a financing perspective. And obviously, one of the things as financiers to these types of projects, we're always looking back. What has happened in the past? How do we avoid some of the challenges that have taken place in the past and make sure that they're going to, get resolved, or we're not going to have those issues? There'll be other issues that come up, but on a go-forward basis. Because at the end of the day, again, representing the debt funders for this, all we want to do is get our money back with a little bit of interest as we're looking at these projects. And again, with the P3 project, a large component of it's coming in from a debt perspective. So as we're looking at the construction sector and what's going on during that construction period, one of the biggest things that we're taking a look at and analyzing is the risk allocation. And, alluding in part to the comments that Ray had made and that Paul had made, is making sure you've got that right risk allocation and that the risks that are being borne are borne by the right party. And the challenge we're seeing with some of these projects is that they're not, appropriately borne by the contractor who's going to be bidding this and going to be doing the construction here. Now, that said, I'm sure for a lot of these things, the authority doesn't want to take that risk on. But there needs to be, so the right entity, and I will tell you the right entity is never the funders. They're not the ones who want to take that risk on. But you got to make sure you've got that right risk allocation, or that if it is getting passed down to the contractor, that they've got appropriate contingencies and trying to figure that out. And that's, again, some of the challenges. And as we're seeing this, as per Ray's graph, where you've got the margins that are getting squeezed here, is one of the things that we're more focused on these days. Another thing that we're looking at as we're looking at the contracting situation and some of the challenges that have come up, be it through COVID or other things that have taken place that are not COVID issues, is the resolution process. And we have seen some challenges as it relates to that. And, from our perspective, we'd like the resolution, as the process to be a little smoother, a little quicker as things are getting done. Now, we still need to have the right diligence put into it and come to the right resolution, but you don't want to leave everything until the end. I mean, some of the challenges we've seen is with projects where, you're offered incremental time to complete the project, yet the issue keeps getting punted down. And they say, well, we'll deal with that once substantial completion is reached. Well, at that point in time, there's no incremental time that's going to get offered. So again, it's one of the challenges as we see it, and trying to balance that out. And how do we get it so we do get that incremental time? Because that's one of the key things as funders we're providing as we're coming into this. Other things that we're taking a look at, still residing and resonating from the bond field situation, right? And, I think with that, we're seeing increased scrutiny by a number of the funders in the underlying analysis of the financial strength of the contractor itself, setting aside what's getting provided with that security package, but what is the underlying strength? And do they have the wherewithal to actually take on the project that they're taking on? So there's more diligence being spent on that. Security packages, again, there's a lot of scrutiny that's going into that. I'm a fan of performance bonding. I think it has a lot of value as we're looking at these projects, but how do you balance that out with the other security that's being offered? And so we don't find ourselves in a situation as what happened with bond pool. The other thing that is a sort of a more recent thing, if you will, over the course of the last year is inflation. As we're looking at the financing and the financial models, we're funders, we're going to take a look at that. We're seeing what's happening with inflation, and notwithstanding, some of the early comments by the Bank of Canada's, don't worry about it, it'll all come back to normal come December. It's not coming back to normal. So now we've got these extended construction projects for which there is no inflation escalator for the most part for P3 projects. And you need to take that into consideration. Where is inflation going to be going? So you're going to be finding a lot more scrutiny from funders when they're looking at the model as to what the inflation assumptions have been and what they actually are going to deliver. We recognize, again, what the authority is asking you to put in there, but what is realistic from our perspective, and making sure that there's the appropriate contingencies there, because that could be quite a sizable squeeze on the overall project with inflation.
Thanks, Vickie.
Rebecca, I wonder if
Go ahead, Ray.
I just wonder if I could jump in. I'm not sure how you wanted to manage this, but Vickie, you talked about the financial health of contractors, and that's a key concern, obviously, of the funding side. The graph that I just showed, I think everyone saw it. If you think of what's the underbilling, the average underbilling for a contractor on a large P3, and underbilling read claims, right? What's the amount that is not yet, it's incurred, but not yet billed? The average was just over $150 million across that study. Now, it's an average, so some are much higher, some are much lower. But if you think of that, even the largest construction organization with very robust balance sheet, to have to finance $150 million even once for a year or two, it's significant. Sometimes companies are financing them twice. They may ultimately succeed, the claim will be resolved, some recovery will be made, but the impact on working capital and the flexibility for that construction company's balance sheet to take on the next job and the next job, it's very serious sort of thing. So Vickie's point about the speed of the resolutions of these things is absolutely critical.
Thank you, Ray. If you're looking at the elevated government spending, what will be the direct impact on the P3 sector? Paul, do you think that if you look at the U.S. infrastructure bill for a second here, do you think the bill will encourage more traditional P3s, or are you seeing more project procured using other type models in the U.S.?
Well, the U.S. infrastructure bill, the majority of it, is tied to, roads, bridges, and that's where we've seen, you know, a lot of P3s in our market, you know, in the U.S. So, you know, it's hard to say what the agencies or owners, you know, are going to do. I think, you know, a lot of it, you know, is the discussion we're having today is how can we make, you know, the P3 procurement model more successful for all parties. You know, so it's hard to say exactly what direction they'll go. You know, but I do think it's a tool that, you know, will be used, or at least, you know, analyzed to see if it fits for that particular project. You know, so, you know, I would expect, you know, that we will see some more P3s tied to the infrastructure bill, and potentially in different markets. You know, Ray mentioned some, you know, some vertical construction versus horizontal. You know, I just don't foresee it not being considered, you know, at this juncture. But it comes down to, you know, what requirements does this model, you know, bring to the project and its, you know, participants. And, you know, and oftentimes we see there's an RFQ process, you know, and then there's an RFP process that is typically, you know, it can be quite long in duration. You know, a significant amount of resources are tied to it, internally and third parties. You know, and so there's you know, a significant amount of cost, you know, that each party, you know, is going to need to, you know, be committed to and willing to take on. You know, but at the end of the day, you know, like we talked earlier, I think it's pretty clear it comes down to this risk profile. You know, and how is that allocated, and you know how each party is best fit to take it. But often it, you know, comes down to the contractor. You know, and I think that's, you know, there's been, you know, projects in the recent past that, you know, maybe you know, weren't successful for whatever reason. We've all read about those. You know, and that has an effect moving forward, you know, on what's the appetite. And I think that's, you know, a lot of reason why, you know, if it's the same risk profile, the same, you know, pursuit, you know, contractors are not going to be as enthusiastic about it. So I think that would answer, you know, some of the questions, maybe why only 1-2 bids, you know, or proponents that are going after, you know, a project. You know, I think a lot of it falls right in that, you know, the risk profile and who's willing to take it or not.
Right. Thanks, Paul. If we sort of moving back to the sort of Canadian perspective a bit here, do you see that perhaps construction companies will pull back from the Canadian market due to more opportunities in the US, leading to fewer construction resources in Canada?
No, I don't. I think, you know, the companies that, you know, work internationally, you know, are still going to focus on those markets. You know, so I don't foresee any impacts. So
I have a question for both Vickie and Ray. Do you see competitive pressure being brought by other jurisdictions that will impact Canada's P3 sector, both from a resource availability perspective and from a model perspective? We're talking about the sort of the traditional P3 model versus the alternative delivery model.
I think we will. I mean, I think you've already seen some of that, right? Is again, I think it's going to be a common theme throughout this is risk allocation, and people are going to gravitate to those markets and those you know, jurisdictions where it's a favorable risk allocation from their perspective, and those are the ones that they're going to focus on. Now, it'd be great if they could bid any and all projects, but we know that's not the reality. And as more and more projects come up, and as we get more in the States, they're maybe going to have to triage and pick certain transactions that they're going to do. I think you're also seeing sort of that development that's coming through is away from maybe the traditional P3 model, and you're seeing some of the alternative delivery models coming. You know, we've got this concept now in Ontario of the progressive DBF or progressive DBFM. I think we all understand the logic for why that has taken place and what this is trying to achieve with that. And we're going to start to see some more evolution with that. So that's coming in. I think some of that's trying to address some of the risk allocation and making sure that you've got the right parties who are bidding for these projects. At the end of the day, we need to ensure, government needs to ensure that you've got the right parties that are bidding and the right parties who are going to end up building and then operating these assets. It's very important to take a look at that. I think one of the other things that's going to factor in is procurement. We know of a couple of projects that, had sort of launched, things were going along great, and then all of a sudden there was a stop, pause, now we're reassessing, and for some of them, they've actually decided, okay, we're going to eliminate, we're going to start from scratch all over again, so they're going to re-tender the whole process and go through an RFQ process. Well, that's expensive for a lot of the bidders, and depending on how far you've gotten. And if you're going to see a consistent theme with that from a procurement perspective, maybe you're going to shy away from dealing in that jurisdiction or dealing at that procurement authority or that underlying asset. It's like, you know what, we've tried it once. Again, people want to ensure that the money that they're going to put forward is going to be for transactions that are actually going to close, that it's going to have the right at risk allocation, and that they actually have a really good chance of winning it. I think that's one of the other things we're seeing as well in this whole process is, again, if you've got 3 bidders, people typically want to go into a transaction where they think they have more than a 33% chance of actually winning the trade. And that's why we're seeing, as Paul alluded to, a number of projects where you're getting less than the number of bidders that the government would actually like to qualify.
Yeah, a couple of thoughts, Rebecca. One is, I think, and we all know this, but I think we forget sometimes, construction companies that play in this space are very, very savvy. And they're really doing what many large companies do. They've got a finite pool of capital, and they're trying to decide, where do we bet the capital? Like, where do we apply capital for a return? So if they're looking at $1 billion P3 with the margins I showed you, or 4 at 250 on design build, given the graph I showed you, you can see what's happening. And not all contractors, but many, they're not just withdrawing from the P3 model. They're saying, look, we have a finite amount of capital that we're prepared to risk on behalf of our employees or our shareholders. And 4 at 250 is a far better risk profile for my company than 1 at $1 billion, especially when the opening margin is the same and the closing margin is worse, right? So I think that's you talk about competitive tension. It's just good business, right? Is driving construction companies to do what you see. It's not an anomaly. I think the other thing is, you ask about other jurisdictions. I mean, I'm not an expert in the UK or Australia, but I think if you're not seeing parades for the success of P3s, in London or in Melbourne. So, I think they've all run their course, but there's a limited amount of success, especially on the large end and the large civil side. So again, I think there is a competitive impact, but there's a finite appetite amongst the construction companies that play in this space, a finite appetite. There is appetite, but it's not unlimited. And I think, you're seeing the tensions right now. It's being withdrawn and applied to the 4 at 250 instead of the 1 at $1 billion. That's what's happening.
Great, thank you. So we've talked about the challenges facing the P3 construction sector. Obviously, in the traditional P3 model, when there's a delay in cost overrun, construction contractors are always the first one to get hit. So what are the lessons learned? What can we do differently in the traditional model? Perhaps we can start with Vickie. Maybe you can talk to us about, from a public sector's perspective, what can they do to help?
Yeah, and this is an interesting one because I've had obviously dealing with the issuers for a lot of these projects, but I spent a lot of time talking to the investors. And you need to make sure you can align everything, because if investors aren't happy, there's not going to be no money for the projects, and projects won't get built. So at the end of the day, the public sector, the procuring authorities need to make sure that everyone is happy as we're looking at this. Some of the challenges that we've seen over the course of the last period of time, I think exacerbated by COVID, a number of the claims that are coming up and how we resolve this is what is the knowledge base of which a number of the procuring authorities are actually going forward on this. And we've actually seen some challenges, if you will, with some of the municipalities who perhaps do not have the advantage of a procuring authority like an Infrastructure Ontario or an Infrastructure BC, who are able to look at a variety of projects, have seen a number of things and help guide them as to a path that should be taken and how you come to these resolutions and actually coming to the table. Because that, again, as we talked about it, and as Ray had mentioned, again, the longer we drag out getting these resolutions to the underlying issue, it just makes it worse and worse. It puts more strain and pressure on the construction contractor, which makes everything more difficult with everything. So we very much would like to ensure that for some of these projects, and again, we are now from a financing perspective, taking a look, and I'm getting asked by investors, who is the procuring authority? What knowledge base do they have in-house? Are they looking at other projects, or is this kind of a one-off project or one of just a small number of projects? Do they have qualified consultants who have seen a variety of different ways to deal with things coming forward? The interesting thing with everything we've got is that you do have expertise within most of the provinces here in Canada. You've got expertise with the federal government as well. For a lot of the large scale projects, you're getting money from the province. For a municipal project, you're getting money from the federal government. So, as part of that, do they not want them to take advantage of some of the information that can be gleaned from that? So, one of the things we would like to see is the public sector, the procuring authorities, providing more of that knowledge transfer between the various different entities, and again across jurisdictions as well, because different things are getting done in different locales, and you want to make sure that you've got that full knowledge transfer. Noting, of course, that the issuers and the investors have the benefit of looking at everything in projects all across Canada, and they're seeing that knowledge, so they want to ensure that that's being transferred.
Thanks, Vickie. So Ray, can you add your comments as well here?
Sure, and I think Vickie's spot on, and what I'm taking from it is, if you think of the process we currently have in the P3 space, the scrutiny and the pre-qualification of the contractor and the project team is intense, right? There's a market soundings, an RFQ, there's an RFP, there's commercially confidential meetings, there's post-close, there's all this focus on, can the contractor and that team around the project, can it perform? And what if it doesn't? How we deal with it? Why do we do this? Well, it must imply some inherent skepticism in the market that somehow, well, the risky part here is the contractor, and that that may be partly true. But I think what's missing, and maybe what Vickie's perhaps pointing at, is what is the process and what is the degree of skepticism on the other players around the piece? Right? Because it's fine to have the documents turned 16 times in a day before close and get the words perfect. The trouble is the people that are doing that are not the ones running the job. And so what's the level of experience and capacity and time and energy of all the players on the team, not just the construction side? And I think, I'm sort of sending a message here. I think, Paul's been on the site for 20, 30 years. How many folks in an average municipality running a big job, how many of them have had 10 years or 15 years? And it's not just time. It's as an example, sort of a proxy for somewhere in this piece, we've sort of focused on, can the contractor perform? There are other questions that need to be asked, and that's what Vickie's getting at. And I think if we're looking for a way forward to improve the process, we need some degree of scrutiny and transparency around the capacity of all the players at the table, not just the contractor.
Thanks. Paul, what about from a contractor's perspective?
Well, and Ray alluded to this, when you get to the RFP stage, you're past the RFQ, you're right in the middle of putting together your design, your proposal, your management approach, but when it's all said and done, you're 30% ish, designed, and that's a component that you deal with in the design build space as well. So it's not to say that, the P3 model is different in that regard, but there's other components that the P3 model brings, and it has to do with the other stakeholders, other third parties that maybe, I'm not going to say it's always the case, but more often, those are further developed, to where the owner has taken, they've advanced the discussions with utilities or found solutions there, what you have to do there, or, other county roads, or, the other stakeholders involved. But, when you get to the P3, all that comes into play. And some of them are they're developed to a certain extent, but they're not finalized. So those are additional risks that, that the contractor takes on and has to consider, in the development of, pricing and scheduling and, closeout, and while at the same time, you've got, short stop dates, long stop, intermediate milestones, pay curves, and everything that you're adhering to. Without the certainty, that you've got a plan that, that you can go execute to schedule and everything like that. So it's a challenge. I'm not going to say I have the answer to solve it here today, but I think it's just something, the team, the project team, inclusive of everybody involved, just needs to, be aware of and think of, how can we better mitigate, these risks and these challenges, to be able to provide, the best possible, avenue for success for everybody. Because ultimately, I'm confident everybody just wants the project to get built on time, on budget, so it can go into operation and serve its intended purpose.
Right. Thanks, Paul. So what we're seeing is that the project running into major delays and cost overruns are mostly the mega linear projects such as LRTs, as opposed to your typical vertical project like hospitals or office buildings. Is it worth exploring whether the traditional P3 model is more suitable for projects like hospitals, or but for more complex linear project, maybe some aspect of the P3 model need to be modified? Ray, can we get your view on this?
Sure, it's kind of a binary question. I don't think it has a binary answer, right? It's not one or the other. I think we've proven that the model of P3, where you sort of share financing and life cycle risk and the impact that has on design and construction, it can be good in many different places. I sort of thought of it in three different ways. One is the pricing risk, whether it's P3 or otherwise. Contractors are really, really good at pricing what they can see, like we all are, right? If you can see it and sort of have a vague idea how to quantify it, you can get your arms around it. That's a risk you can transfer. If you can't see it or it's not knowable, then if you think you're transferring it, you're not really, right? Because no one's really got their arms around it. I think we make a mistake there, and so that, I'm not sure it's unique to P3s, but that pricing risk, and Vickie said it right off the top, the party that can best manage the risk is not the one who can pay for it, but the one who can see the risk, right? Who can actually see it and quantify it. The question about sort of the collaborative model, and do you move into that space in P3? I think it works, that the P3 model per se, and we've probably seen 50, maybe not as many as Vickie, but probably 50 to 60 of transactions myself. The model's not broken, but I think we do need to be more realistic about this risk transfer and acknowledge that you can't always transfer the risk and forget about it. There's one tricky piece about the collaboration bit, and I assume you wanted to go here, Rebecca. I think we may talk about it some more. If we're collaborating at the construction and the project co-level, I think a limiting factor is what extent can the finance community actually be collaborative in that moment? I don't know. Vickie's the person to ask this, but I think my instinct is, and experience is, the finance community has far less ability to be collaborative in the moment on the fly than Paul would have, or we would have, or a contractor, right? So I think that's a limiting factor. And I say that because if you have collaboration in one box and rigidity in another box, that's not a successful model. That won't work ultimately, right? So we can't just go headlong into collaboration without sort of dealing with what do you do with the inflexibility of some of the finance structure that's necessary, right? So I think that's a bit of a conundrum, and we should be cautious how far we charge into this collaborative thing until we address that.
Thank you, Ray. I think you just answered one of the audience questions is about the collaborative model, but I'm sure we're going to talk a bit more about it later on. So I want to move to a different sort of aspect to the questions right now. So we believe there is some level of correlation between the size, complexity of the project and the likelihood of construction issues that cause delays and cost overruns. We've seen an effort to de-risk some complex projects were sliced down into smaller portions. We've seen for example, Eglinton LRT, the tunneling and vehicle are separated from the project. The recent project Ontario line, they're procured by sort of using three, different P3 models, and there are some early works as well that are not part of the P3. And the RER projects as well, and the regional rail, regional express rail projects, they are procured by different GO train corridor. So really the question is, perhaps Vickie, can you comment on whether breaking project down into smaller pieces is an effective way to manage the risks? And also, how do we find the right balance of breaking down project versus managing integration interface risk?
Yeah, no, happy to address that. we do see the value in it, and as Ray had talked about it up front, right? Whether, would you prefer to have 4 $250 million projects or one $1 billion project, right? Because again, you could have one of the 4 250 go wrong and the other 3 are going right, rather than you got something that goes wrong in $1 billion. That puts a big strain in the construction contractor. And so again, we're very mindful about the strength of the construction contractor, what they're able to deliver, how comfortable they're going to feel with this. And we need to make sure that that construction contractor, even a consortium of them, are going to be comfortable with the risk profile they're taking on. No one wants to feel that they're betting the company by doing an underlying transaction. So we understand the value of breaking it down into various component parts. For us, it's a matter of looking at what are those separate parts? Can you completely ring fence what the risks are? Recognizing that for some of them, there is going to be some interface, especially we've got some of the projects where we've got a tunneling component, and then you've got, the civil works, and sometimes, the systems or the vehicles could be even separate from that. And how do you make sure you've got the right interface between all of that, and that you actually can have people who are, pinpointing exactly whose risk resides with who? There are always going to be disputes and delays as it relates to certain things, but you also need to have the right process and the resolution to get comfortable with that. At the end of the day, we as funders are comfortable to look at the various component parts, and they've got to be a manageable size. I would admit I don't ask people to make the projects too small, because if you make them too small, then you make it more challenging for the bond market to take a look at it. Last time I checked, for anything that's going to be sort of medium term or definitely long term here in Canada, it's going to go to the bond market. So you need to make sure you've got sort of that critical mass and size for them to take a look at that transaction. But I think there are ways to look at this. The other thing that we look at is the ability to break out, some of the different complexities you have in a project to make sure you've got the right contractor for that project, right? And you want to make sure you've got the right parties that are involved. So again, as part of the shortlisting process with the RFQ that, the procuring authority is going through, is ensuring, here's the complexity we've got here. This is the right team of people to take a look at this. And then we've got that all aligned. For us, it's very much trying to get that all combined together, so we've got the right risk transfer. Again, everything goes back to risk transfer, risk allocation. Who is the risk properly residing with, and do they have the wherewithal and the financial strength and expertise to be able to deal with that?
Thanks, Vickie. Ray, what do you think about this topic?
It's tough to say absolutely that bigger contracts, are necessarily riskier. You should always chop them up, or you shouldn't. I think that's not accurate. But it is true, I think, as I said earlier, contractors, even the largest, have a finite balance sheet, right? There's only so much that a contractor could take on. And I can tell you, as I'm sure Paul will too, 4 at 250 is a different strain on a balance sheet than 1 at 1 billion. Right, so the impact of something going wrong on that is quite significant, even for the largest company. So I've made that point. I think the other thing is around. We always think of it as labor, but it's not just labor. If you think of $1 billion contract or a very large, complex LRT, even if it's not quite $1 billion, although I'm not sure how many are under $1 billion, the leadership on that project team, I would suggest, is CEO level leadership. Right, these are not projects like others that you're running. Essentially an enterprise on the site with all of the things you're dealing with. It's not just kind of coordinating the trades and checking off the invoices as the concrete's delivered. So it's a CEO level proposition. There's a limit to how many individuals in North America, or around the world for that matter, who can actually do a $2 or $3 or $4 billion LRT project. Like there's just there's a limit to how many people are there. Those that are there have been on the job for 20 years, right? They're not 5-year veterans, they're 25-year veterans, and they don't have an unlimited horizon. So there's a challenge there in terms of capacity. So even if contractors are willing, there's a limited number of people that can staff those jobs. Well, there's a knock-on effect though. So even for a large company who can pull people up through its ranks, develop them quickly, get them in, they've also got another $1 billion or $5 billion in backlog, other jobs that are now being run by people that are being pulled up below that. So it puts the enterprise, the construction company, even if they staff the biggest job, to do that, they're drawing resources from below, and it makes the whole backlog of a contract a little less comfortable, right? So that it's not an absolute question. Smaller jobs make it easier. Bigger jobs are bigger stress, not absolute. But these are some of the dynamics, I think, that go into these decisions. Paul, I don't know if you've got some thoughts. You live there.
Yeah, no, well said. I don't have anything to really add to that. Other than, it depends on the timing probably is a big thing. The status of organizations, where they're at. you know, and really comes down to, you know, what are the owners' needs? You know, is there a time frame when they need, you know, the bigger project done by, versus if they broke it up, you know, there's potentially some coordination overlap with contract issues. You know, I think it just needs to be analyzed on, you know, what's the net gain, you know, deciding if it gets broke up or not, you know. So.
Okay, thanks, Paul. We have about 5 minutes left. I think it's a good time for us to go to the audience questions. I see a bunch in the chat here. I'll just go with the first one here. This is about the collaborative model that were discussed earlier in the keynote. The audience wants to know that this model typically requires the owner to take back a significant amount of project risk. What tools can the owner use to manage project risk in this type of model? Perhaps we'll start with Vickie.
Sure. Well, one of the things I could do is use some external private sector financing, because I'm going to put a lot of bells and whistles and things on this, and to make sure that we get our money back. And that's, I mean, it's something I got to tell you, it really grinds my gears sometimes when I see what's going forward. And, you know, government maybe doesn't have some of the rigor that we have and that we bring to all of this, right? At the end of the day, you need my money. And I'm happy to provide my money, but there are certain terms and conditions on which that is done. And everything will work fine, you know, as long as everything's working fine. I always say the last thing you want to do is bring the funders to the table, right? That means something's gone horribly wrong with everything. But you know what? Bring some element of private sector funding into the process. There are different ways to do it. You don't have to have commitments up front. We've done things where we've got, you know, you've got development agreements, then you move to a project agreement period. We've got this concept of the funding coming to the table, funding competitions. We're prepared to work with to try to find some creative solutions here. But I think we can actually deliver a lot of value as the funders. And I think we're aligned with a lot of the people in trying to get the project done and doing it in the most effective manner possible.
If I could pile on, Rebecca, I don't know how far you want to go in the questions. I think the risks are the risks, right? You can either try to allocate them at the beginning, codify them, check them in stone, and then fight about it later. That's the traditional model. Or you can say, we're going to codify the ones we know, and then when other things happen, and they will, we are going to agree that then we'll figure it out on the fly. We'll collaborate, we'll compromise, we'll sort of discover new things, and so on. But that's different, right? If you're doing the earlier model where you just codify them, lock them in, and move on, you can put a finance instrument, you can put a bond or an LC against that. But where you've got a shift to say, we don't yet know the risks, we don't have a process for solving them, we're going to agree to collaborate. What that means is we don't know what we're going to have to do. That's what it means, right? It implies the unknowable, right? And we're going to sort it out together. Well, that means you can't transfer, you can't secure that risk, absolutely, right? So I think if the question is from the owner's side, it would be to recognize, the tool is to recognize that you're not actually transferring risk, right? You're going to figure it out and then deal with it in the moment. That's what collaboration, I think, means. So anyway, that's a thought.
Right. We have about a minute and a half left. I want to squeeze in one more question here. What is the number one risk to the P3 sector in the short term and long term?
What is the number one risk?
Yeah.
Well, from a contractor's perspective, I'll say it's you know, it's schedule, it's time.
Right. Well said. We're almost out of time. I apologize, but we didn't really get to all the questions. Please get in touch with us after the section. We'll make sure all your questions are answered. I'll ask each our panelists to close out with their parting thoughts and before we sign off. Vickie, Ray, and Paul, please. Just perhaps 20 seconds each.
Well, look, more projects, please. I mean, that as I see that as the biggest risk. I mean, we haven't had enough of them. The market has got a lot of money. We've got a lot of money to deploy into a lot of projects. Please bring them forward. Let's make sure we've got the right risk allocation. Let's keep our contractors happy. At the end of the day, contractors happy, funders happy, the authority will be happy, and so will the voting public.
So I'd second that. I think, but as you deploy the money into the projects, I think the collaborative direction is a good one. Be cautious though, it's a different culture that's required. You can't write the contract with green words, but behave as if it has red words, right? The parties in the deal have to recognize what collaboration means.
Yeah, I agree, Ray. No, I just want to thank everybody for the opportunity, and look forward to projects coming, and I anticipate that we'll see some changes in the model that are going to be positive. So appreciate everybody's time today.
Thank you. That takes us to the end of our discussion. Thanks again for our panelists for a fantastic discussion. Thank you everyone for sending in. And I want to thank you again for the C2P3 for hosting this event. Enjoy the rest of your afternoon. Bye for now.